Good afternoon. Hope you are seeing the slides also. In fact, the two slides that we have covered, two lectures that we have covered last 2 weeks, broadly gave you all a picture about how the program and how the contents in terms of the course of economics of monetary policy and financial markets, and also relevant insights into key concepts that you might come across with respect to the areas that we are covering, but from a very broader perspective. But the nitty-gritties and the details that we started getting into through the financial system lecture that we started last week, and I hope most of you all already familiar with some of these details from our discussions. And if you do not see anything that I'm discussing and detailing is not necessarily clear from your general understanding, please drop me a text so I can also follow up straight away while discussing with you all. So you can still activate your chat mode and communicate anything that you wanted to clarify in detail. But from a broader perspective, what we are simply seeing here is the details of the discussion that we had over the last 2 weeks or so before we are starting a very, very interesting and important area of discussion, that is on interest rates. So that's we will be starting today. The handouts, if I'm not mistaken, been already shared through the system by the IBSL. But before moving into that, I would still cover a few slides that we couldn't finish last week. We basically kind of come to the point where we have more or less looked at the financial intermediation and indirect finance. Indirect finance, you know, it's not direct finance, that you are basically using intermediaries to match the gap between borrowers and lenders. So the financial intermediaries, mainly the banks in the financial markets, are the main players in the indirect financial market. So indirect finance is mainly third-party finance into your portfolio. So they come with all other details. So you have covered some of them in our discussion last week, and today we are basically concluding that this indirect finance also help to allow small savers and borrowers benefit from the financial market, because you see big time players, big institutional investors, big high net worth individuals, they have the know-how, they have the capacity, they have the skills to greater extent to manage in the financial markets, whereas small timers, they probably have to kind of follow through the existing modalities, and the most common and most Fs go and deposit their existing reserves or the savings that they have, and these savings being channeled by the financial intermediaries to entities who have a requirement to finance. So the agencies or the institution who wants money, the borrowers from another perspective. So they are the ones who get these services. So ultimately, these small savers and borrowers benefit from financial markets and the indirect finance, whereas big time players always have the know-how and the capacity to drive their own modalities in the financial markets in terms of both driving investments for their own asset classes like equities. Equities means the stocks. So you become a stock owner means you become the owner. So they channel directly the funds to their own investments. So the lenders, in the sense savers in such circumstances, are also to some extent sophisticated investors. So they know about the markets, they know about the processes involved, they know how to kind of work through the legal implications, and ultimately these institutions also capable of financing their big volume financing requirements from the market itself without kind of going through a third-party institutions to finalize finances. So this is where we stopped last week in terms of indirect finance, and then we can move on to another very important area of this financial structure, that is the regulation of the financial system. Okay, so the regulation either by self-regulation or through a system of regulations, mainly by the financial regulators. Either it's a central bank, monetary authority, you can call it also a financial services authority, FSAs. So these are the agencies that you find in any country. They govern financial system regulation. On top of this, you might come across Securities and Exchange Commissions. Okay, so SEC in the case of Sri Lanka, Securities and Exchange Commission. They also regulate the financial market in the form of equity and other related financial market regulation. On top of this, there may be circumstances you might see ombudsmans. Okay, in Sinhala you call it so-called Duggannaralas, ombudsmans. So they are the ones, they also act in financial markets to kind of facilitate the grievances of investors and the borrowers, savers, and in a way, savers are the ones who have excess assets, and they go and invest in financial assets, and the borrowers in this instance in the financial markets, if it is direct finance, you know, the institution itself through issuance of instruments in the market, if not through a third party, that is intermediary, that's mostly banks. So these are the kind of, you know, people engage in the market, so they could get the services of an ombudsman, and he will look after the concerns of these agencies. From a broader perspective, you see all these possibilities, and interestingly, these regulations have evolved from a very basic regulations to much more complex regulations in recent times. So the details of these also would be discussed at different times based on the complexities of required regulation as we move on. Okay, so what this regulation after all tries in a very basic perspective is to reduce the asymmetry. You know, asymmetry is the parties to transactions do not process equal amount of information. One party might have very big information, detailed information, the other might not have. This may not only due to the availability of information, but also due to capacity of understanding, recognizing the details of available information. So what these regulators often do is they try to increase the information available to investors. Thereby, they reduce so-called adverse selection, wrong selection, and moral hazard problems. Please understand this, both adverse selection and moral hazard problems that we are now talking here would repeat all throughout this program on a repetitive basis. Okay, adverse selection, that means you select the wrong party to the transactions because you tend to you either do not have enough information. If not, although you have information, your capacity to absorb that information is different. Okay, moral hazard is you depend on third parties to divert your risks. So you possibly taking unwarranted risk in the transactions. It's like you are having an insurance, because of that you don't take care of yourself. So you fall back on insurance cover, so you take excessive risk. So these are possibilities of moral hazard. So we will come to this both adverse selection and moral hazard in greater details as we move on in this discussions. So regulation will facilitate to reduce this adverse selection and moral hazard problems. And then of course, another very important aspect is it reduces the insider trading. So insider trading is the price beneficial information for parties to the transaction. Some might have price beneficial information, whereas others do not. So through regulation, the systems are put in place not to have such insider details for certain number of participants in the market, but they wanted to have this information generally across the market participants. Okay, so this is why you probably find the financial regulators restrict information dissemination on a piecemeal basis. So they probably introduce information dissemination arrangements through a broader arrangement where market participants have to reveal or inform markets on a continuous basis through public announcements. Even if there's a change in CEO, even if there's a change in key management positions, if there's a change in projects that they undertake, new projects that they have signed, right? In new investors being brought in terms of participation in the projects. All these details have to come with more broader public announcements by the institution concerns, rather than allowing few parties in the process benefiting from such information. These are the things we call insider trading, but the system, the regulations are there to reduce them. So what regulations, after all, tries from a perspective is to increase the information available to investors through reducing adverse selection and moral hazard, and also reducing the possibilities of insider trading. So similarly, you probably see the regulation in financial system has evolved, okay, to ensure the soundness of financial intermediaries. Financial intermediaries, when we talk about financial intermediaries, naturally what comes to your mind is the banks. Okay, so they manage mostly other people's funds, right? So if you look at the bank's capital, if you look at banks' assets, only a very limited share of that assets belongs to owners, right? So in fact, I mean, it's effectively belongs to owners from a broader perspective, but what you simply see is, so the assets have been covered by bigger share of liabilities in the bank's portfolio itself by all these depositors' money. So depositors are the ones mainly bringing money. If not, the bank has channeled directly through issuances of debentures or through other modes of financing arrangements. But still, it's a liability in its books. So assets being covered mainly by the liabilities, right? So you probably see the soundness of these financial intermediaries need to be looked after by a third party, not necessarily by themselves. So they would actually look after some of these considerations, but a third eye is very important. So these financial regulations bring in, okay, so-called soundness to financial intermediaries in the form of entry chartering processes. By chartering, what it means is you do a screening. You can't have free entries like other industries in an economy. So you might see the entry restrictions in the form of maximum ownership limits, right? Required the background checks, and also expertise and experience in the form of people who are engaging in financial markets, and also so-called fit and proper evaluation. So you find key personalities in financial institutions being looked by the regulators for fit and proper. That does not mean they are physically fit and proper in shape. No, that also important. But what you are basically looking there is they are looking at the background in which they have maintained their credibility and the kind of merit in which they process certain requirements in the form of holding certain positions in financial market. So this is very important. So restrictions of entry coming with very important aspects of capital requirements. You can't just come in as a bank without a very basic high amount of capital. So this is this requirement changes over time. From time to time, you find now so-called regulations comes in with capital adequacy requirements, and also on top of basic capital requirements. These numbers changes with different time periods in a business cycle, and you find the entry is not easy as other industries in an economy. So through which they find out the new financial intermediaries or existing financial intermediaries soundness. And then you find disclosure of information, right? So these financial intermediaries, banks and other institutions have to disclose on a regular basis a certain type of information to the market participants. If you are a listed company, that means you are listed in the stock exchange for that matter, okay, publicly quoted a company, your disclosure requirements are much more stronger. So you require to file audited accounts on a quarterly basis, and also on a regular basis you have to have a certain type of information based on your type of business engagements need to be disclosed to market participants. Okay, so then of course there's a restriction on assets and activities. Okay, so there's a restriction in the form of what type of controlling interest banks could have on other type of businesses, or within the same type of financial market activities, how much of a control they can have on a similar type of business entity. For instance, if you are a bank, you can go and buy another bank, but then you see single ownership limits. So maximum ownership by a party to another financial intermediary is more often like a 10%. And sometimes it might be 15%, or in some cases, the regulators, central banks might allow on a case-by-case basis for a higher percentage ownership allowance. Okay, but that is not the standard, but standard is single ownership limits. So the single ownership limits also evolves over a period of time. You can call it, let's say, 10% for the time being. So that's the maximum single ownership in a financial institutions one could have. For instance, Bank A in Sri Lanka could have the kind of interest in Bank B up to 10%, not more than that. If you allow that to happen by, let's say, 50% or so, so the Bank B is effectively a subsidiary of Bank A. So they could act as a cartel. Okay, so there's a restriction in terms of type of ownerships that could have, and also similarly on assets and activities. Okay, what type of assets that they could hold. They could hold risky assets, and in the eyes of regulators, they cannot hold more than 20% of their portfolio in that type of assets, right? So you probably find some financial intermediaries exposed to certain type of economic activities. Let's say they are exposed to agriculture-related lending. So agriculture-related lending is part and parcel of often all the financial intermediaries. But if you are exposed too much, okay, cyclicality, seasonality, and weather-related developments might have impact on agriculture very often. So when the agriculture being hit and everybody is down, so this financial intermediary also having difficulties in the form of non-performing loans, non-performing assets. So they restrict the ownership of these type of assets by these financial intermediaries. So similarly, certain type of activities, whether they could do primary dealership, they could do brokering, they could have a custodian arrangements. I mean, these restrictions could come in. Usually they can do such activities, but on what basis, how they have, whether they have required firewalls being established. They look at all these things. So this is very important aspiration in the form of regulations that been introduced in the financial intermediation. You probably see deposit insurance in today's context. That is very important because in recent times, deposit insurance have helped to reduce bank runs, if not avoid bank runs to great extent. Because if everybody start believing that this bank is not in a position to honor my deposit obligations, I would go and withdraw my money, right? So when everybody start doing that, you accelerate the bank run. So what happened there is everybody pulling out the money, and the bank do not keep liquid assets to that extent in their day-to-day operation. How to now fire sell its assets. So when there's fire sell, what the price they get is very low, right? Lower the price, higher the interest rates. So what you are basically saying is they are selling at a very low price, at a substantively low return to whatever the assets that they had, if not at loss. So what it ultimately drives the bank is banks assets conversions become not sufficient to meet banks liabilities, and ultimately bank is in a kind of a position of bankruptcy. So deposit insurance has brought in discipline in the form of up to a certain amount of your deposits, the deposit insurers, right, covers the liability. So because of that reason, even if there is a possibility of a difficulty in the bank, people are not rushing to the banks to withdraw. They can fall back on deposit insurance because they know up to this much my insurance would cover my a payment. In fact, that is indirectly a moral hazard behavior. You should know what your bank is doing, and if your bank is not doing right, you should kind of take your deposits out. So that's a kind of a rational behavior. But in the form of a deposit insurance, what you have brought in here is the possibility of everybody is pulling out their deposits at the same time being avoided, and thereby bank runs being avoided. So deposit insurance would facilitate third parties being looked after, but at a cost. Okay, so when you are getting usually a certain percentage of return, probably because of the introduction of a deposit insurance, you might not be getting that full amount. The banks would keep a certain margin from your return for deposit insurance arrangements. And also from another perspective, regulations also ensure the soundness of financial intermediaries by introducing limits on competition. So you see competition is there, but you probably put brakes. You don't need to drive this fast. You have to go on a certain speed. So these are the brakes that the regulators bring in and introduce to a certain form of activities. Probably in the past, the branching restrictions were introduced, but today the branching restrictions were not necessarily something the regulators would like to introduce, but it's naturally happened. You expand your branches, your overhead costs increases. So you yourself, financial intermediaries, they themselves limit the branching exercises. They don't want to just go and open a new branch in some place. Instead, they probably like to see how many customers they could serve without having a branch, and then see access for the financial arrangements through other modes in today's electronic banking environment that we are looking at. But in the past years, there were limitations. So you have to have branches only in the capital city, not in remote districts, especially for foreign banks. There were restrictions like that. But now, as I said, it's going down in importance, but what you are simply saying is still these could be introduced. So then, of course, restriction on interest rates. You already know, higher the interest rates, higher the risks. So the financial intermediaries, they try to pay above the market level interest rates. What you are basically seeing is they are invariably introducing certain risk assets into their portfolios, and they are taking risks more than what the financial intermediary should be taking. Because of that element, their activities would be highly vulnerable to possible market risk and other related risks that you might be studying in this process. So these restrictions could come in. You can introduce interest rates, but interest rates have to be within this framework, not beyond these levels. Because if you are going to have a very high interest rates, that means you also need to have very high return for your activities. But in the economy, if you don't find general economic activities facilitate such return for your investments, so that means there's something missing in that interest rates determination process, or the return they have given it to their depositors. So the authorities or the regulators might place some breaks into such arrangements. So these are the purposes of this regulation that brings into the financial system. So you now see both direct finance, indirect finance, and then of course related consideration for regulation. So these are the areas that we cover in this lecture, and I hope that you have a reasonable understanding into the areas that we have covered so far into this discussion. And if you have any question, please feel free to drop me a message so I can quickly follow your concerns in that area. But what you are simply seeing here is still you could see if you have any concern that I can also follow up in terms of explaining and discussing before moving to the new slide that we have, new presentation that we have shared with you for today's discussion. And that area is the behavior of interest rates. This is a very, very important area of discussion for this particular course. Okay, so please feel free to communicate if you have any concerns, and I will move on with the new topic with you all, and I hope you have the handouts already. I hope you have the handouts with you all, so we can move on to the new area. This is the new topic that you are looking at today. So you probably see the interest rates being one of the topics very widely discussed in today's financial markets. So you find these interest rates not only discussed for general purposes, but also for the purposes of your own return for your investments by in various financial assets. So you see these interest rates. When we see interest rates, you probably find at different periods of history or different times of your understanding, you find these interest rates are substantively different. For instance, if you look at the kind of after the Second World War in 1950s, like in US case, the 3-month treasury bill were about 1% interest rate. It's trading at 1%. But by 1980s, this has increased to almost, okay, almost 15% or so. Okay, so you see this interest rate substantially different across these different period, but then substantively reduced over the recent years with the financial crisis that you have seen towards 2008, 2009. These interest rates have come down substantively. Okay, so you see this interest rate varies for the same financial assets at different periods of time. In Sri Lanka too, if you take interest rates for government securities, that also behaved very similar pattern. So what you are simply seeing now is a 1-year treasury bills are trading around 6.80, 6.8%, yes. That is 364-day treasury bills. But if you look at this same treasury bills towards the end of last year, this was trading around 9%. But if you look at this in early 1980s or so, would be trading closer to 18% or 16%. So in Sri Lanka's case also, the levels of these interest rates are substantively different. What explains this substantive fluctuation in interest rates would be one objective of the area that we are going to study today. Okay, so by studying the money, banking, and financial market, we try to kind of bringing answers to these questions. Okay, in this section, we also examine overall level of interest rates. When I say interest rates, and when somebody else quote interest rates, unless otherwise very specifically mention what this interest rate is, always these interest rates are called nominal interest rates. So whatever interest rates I just put it out and discuss with you is nominal interest rates. Okay, so everybody in the market are familiar and express their interest rates in nominal form, right? And And then, of course, we try to kind of understand what factors influence this nominal interest rates in this course. In this lecture, we are trying to understand that. So also from our previous discussions, you probably kind of, got a kind of a feeling the interest rates are negatively related to the price of that financial assets. So what I mean by negatively related is when the prices are high, what you simply see is interest rates are low. Okay, when the interest rates are high, what you simply see is prices are low. So we see a financial assets like bond, what you probably see is bond's par value is closer to 100. So as long as you get closer to 100, what you are simply seeing is interest rate is basically come closer to its coupon rate. If it depart farther, that means far away from 100, so let's say it comes closer to 80, so you probably find its interest rates of this bond is very much higher than its coupon. Then there's another factor that also drives this, time to maturity. But we will see for the time being, very simple understanding, the price and interest rates are negatively related. Higher the price, lower the interest rates. Lower the price, higher the interest rates. This is like a mantra. Please remember. Okay. So when the bond prices change, we can also explain where the direction where the interest rates are now fluctuating. So when you see that bond prices are closer to 100 and the interest rate is, let's assume 5%, but when the bond prices reaches 90, you are very much sure the interest rate has to be higher than 5%. Okay, because lower the price, higher the interest rates. So you should be able to kind of, get the direction of these interest rates in this lecture. And why the interest rates changes and all, we will come across and try to understand. Okay, so to do this, we make use of simple supply and demand analysis for financial assets. We take bond market demand and bond market supply in deriving so-called price, the equilibrium price, and then of course the changes to the interest rates. And also we look at money market. Okay, so the money market and bond market are one to the other, so it's an alternative. Or if you are investing in bonds, you would not be able to invest in money market. So if you are investing in money market, you will not be investing in bond market. So it's a kind of easy understanding per se, but we try to understand the relationship between these financial assets in this lecture, right? So through this discussion, we try to kind of try to relate when the prices of these assets changes, how the interest rates would behave. Okay, so in order to derive this demand curve for assets like money or bond, because bond market you see the financial assets bond, in the money market you see the financial assets money. Okay, the first step in our analysis, we must first understand what determines the demand for these assets. Okay, what drives the demand for financial assets? So this is the question that we will be posing. Okay, to do this examination, we go behind the economic theory of asset demand. There's an economic theory called asset demand. So we will try to get into this asset demand and try to explain what drives the demand for financial assets. Okay, so this theory of asset demand outlines the criteria that are important when deciding how much of an asset to buy, how much an asset to hold, why that asset is important, all kind of things. Okay, so through this understanding, we can then go on to derive the demand curve for treasury bonds or money in the market. Okay, so after this, you can derive the supply curve for these assets. We develop the concepts of market equilibrium. So through the same demand curve concepts itself, you can derive the supply curve arrangement itself, and then you can come to the conclusion where the market equilibrium is. It is no different to your basic understanding of supply and demand in the goods market. You probably done this thousands of times in your previous studies, right? So this engagement of supply side and the demand side would derive you the equilibrium. So the point at which quantity supplied and the quantity demanded equals is the equilibrium that we are familiar with. Okay, so then we use this model to explain the changes that happens in the equilibrium interest rates. What happened when the quantity demanded increase? What happened when the demand curve shifts to the left? What happened when the supply curve shifts to the right? So then we will see what happens to the quantity of instruments asset demanded, and also what happens to the interest rate. So it's very straightforward analysis of your basic understanding of economics into the financial market and financial assets equilibrium prices that we are interested in. Okay, so you already know two very important concepts now. First is the price and interest rate relationship. It is negative. Higher the price, lower the interest rate. And similarly, now you know through theory of asset demand, we would be deriving demand curve and supply curve, and then the equilibrium points for financial assets. And our main example in this discussion is the bond market. Okay, so we will look at it from that perspective. Then, of course, another consideration we would look at is interest rates on different government securities. So financial assets tend to move together. Okay, in this section we will proceed as if there were only one type of security and a single interest rates in the entire economy. That's for our easy understanding. Okay, we put all assets into the bond basket and try to kind of understand it from that perspective, because when you see bond interest rate increases, it's very simple that you probably find other financial assets interest rates also increases. Otherwise, everybody will come to bond market, not in the other financial assets market. So then what happens is those assets prices reduces, and then the interest rates of those assets will increase. But usually when the interest rate structure of an economy changes, generally it changes together. Okay, in following sections that we are studying under this program, we expand our analysis to look at why interest rates of different type of securities differ. So there are reasons and explanations that we will bring in, and we will try to apply those in our future lectures. But for the time being, we try to kind of pool everything together and look at it from a bond market perspective. Any questions? So you see now the interest rates behavior, we mentioned about so-called theory of asset demand. So now we can go into details of the theory of asset demand. So what determines the asset demand is the questions that we pose to ourselves. So what you see is four very important aspects which determine a demand for financial assets. Okay, first and foremost, the wealth. Okay, so wealth include not only your earnings by being employed in a very good employment. That is only one part of your wealth. You get that remuneration, and that adds into your wealth. But wealth could be from your parents, whatever that you have inherited, or from the other assets that you already possesses with you, property, okay, collections, okay. So whatever things that you possesses now with you, that covers the wealth that you are talking here. So it's the everything that you own in terms of assets. So that's the one concept which is very, very important, because you feel rich when you have more wealth. So when you see that wealth, okay, you tend to kind of feel that you are in a position to demand assets, more assets than a person who is having lower wealth or who does not possess a wealth. So one aspect of this asset demand is wealth. So please take that wealth as a very important consideration. and this includes total resources owned by the individual, including everything else: your collections, your paintings, your gold jewelries, your whatever properties that you have, whatever assets that you process outside your country, whatever assets you inherited from your family and the parents, all includes here. Okay, so that's a very important determinant of asset demand. Then you see expected return. Okay, so here you try to kind of recognize expected return of one type of assets to the other. If you expect the return of a bond would be greater in the next period, okay, let's assume you are investing from today to 1 year from now. So 1 year investments that you are making. So you expect this return to be higher than the return of other assets. Okay, so then that is also the driver of asset demand, right? So here you put one type of assets and all the other assets into another basket for easy understanding, as we discussed in the last slide. So what you're basically looking at in this instance is your expected return. If you think that these assets would give me a greater return, I would expect, I would demand this asset. Okay, but then remember, return and risk has some relationship, but for the time being, you just take expected return also as a greater determinant of asset demand. And then D, so-called risk. So risk is again a very important determinant of asset demand. So the risk refers to the degree of uncertainty. Okay, the degree of uncertainty associated with the return on one assets relative to all the assets. Now we look at bond. So you look at this bond and you have seen that this is now returning greater, expected return is greater. That's why you preferred bond. But at the same time, you look at the risk of these financial assets too in relation to other assets that you are interested in. So when you see the risk is the probability, if not the uncertainty, that this bond would honor its obligations. So when you see a bond would honor in the form of coupon payments from today to next year, or if the next year is the maturity year, you probably see coupons plus principal at maturity. So that the expected payments of this bond. But the risk is how uncertain these payments are. Whether the government is in a position to honor, or if it is a debenture or a corporate debt, whether the corporate is in a position to honor their obligations to settle this on time. Okay, so you look at this risk also as another very important determinant of financial assets. And the fourth very important consideration of determination of determinants of assets is liquidity. The liquidity is the ease and speed. Okay, ease is how easily, without engaging in activities that requires your time and at the same time extra transaction costs. Often when you wanted to liquidate a financial asset, some transaction cost involves, right? So this some transaction cost should be marked no, not necessarily excessive, and it's difficult, right? So the liquidity is the ease and speed with which an asset can be turned into cash relative to alternate assets. So how quickly, how easily you can convert the assets into a cash form. That's the liquidity. You know, easily exchange over the phone, over the counter, right, OTC, or over the screens where the electronic trading systems are available. You can convert them into cash, and the required cash would come into your accounts. But if you look at, even for that matter, a property, it's not that easy. You have to go through a process. You have to find buyers. Then you have to go through a legal documentation process. And also finding a buyer and kind of come to an agreement in terms of the prices takes time. And also in the process, there may be a lot of uncertainties, right? So the liquidity of certain assets are different to certain financial assets you probably be looking at. Even within financial assets, this liquidity differs, right? So liquidity of a shorter tenor financial assets often has a higher liquidity than a longer tenor financial assets, because time to maturity is longer, means anything could happen. Uncertainties are greater. So you look at these things from this perspective. So when you say the theory of asset demand, there's these 4 determinants of asset demand: wealth, expected return, risk, and the liquidity. These are very, very important considerations, right? So how, in which direction, right, the theory explains these determinants behave in terms of determining the asset demand. But in this concept, you hold all other factors constant, simply because in economics, other factors also start behaving differently. You'll probably find the behavior of the determinants that we discuss also would change. But for the easy understanding, so-called ceteris paribus condition being applied. So you hold everything else constant, and then you figure it out, so-called theory of portfolio choice, or for that matter, theory of asset demand, right? The quantity demanded of an asset is positively related to wealth. Quantity demanded of an asset is positively related to wealth. So what it means is, higher the wealth, higher the demand of the financial asset. So you are rich, you have more demand for financial assets. Rich is a narrow way of explaining wealth, but wealth includes everything else. So when you have a bigger wealth, your demand for financial assets and assets in general is greater. So higher the wealth, higher the demand. Lower the wealth, lower the demand. So it is positively related. Okay, so that's the first determinants, but you keep all the other factors constant in this consideration. Then of course you look at the second consideration, that is expected return. We discussed what is expected return is. So the quantity demanded of an asset is positively related to its expected return relative to other alternative assets. So what you are simply saying is, higher the return, higher the demand. Lower the return, lower the demand. So when you find the financial assets bond giving you a higher return, you tend to demand more in bonds. Not only you, others also. That means other people also start demanding bonds, and that would drive the demand for bonds. So basically what you are simply seeing is, wealth is positively related, expected return is positively related. Then you look at risk. Okay, so quantity demanded of an asset is negatively related to the risk of the return of its returns relative to alternative assets. Okay, so when you see uncertainty of the financial assets giving you its obligations, that is returns that we are talking, so higher the uncertainty or the higher the risk involving these financial assets will give you its promised obligations, you find the demand for these assets is low. So it is negatively related. Higher the risk, lower the demand. Lower the risk, higher the demand. So you have seen wealth and expected return. Higher the wealth, higher the expected return, higher the demand for those financial assets. But when you see higher the risk, you find lower the demand. So it is negatively related. And the other fourth point that we are now looking at is so-called liquidity, speed and ease in which you can convert the financial asset into cash form. Please remember. Okay. So when you see speed and ease in which financial asset could be converted into cash form, that is the liquidity. So when you see higher the liquidity, right? So you find it is positively related to the financial assets. So financial assets demand increases, right? So when you see liquidity is greater, the demand is greater. Higher the liquidity, higher the demand. Lower the liquidity, lower the demand. So it is positively related. So what you are simply seeing here is wealth, expected return, and liquidity are positively related to the asset demand, whereas risk is negatively related to the asset demand. So to say that wealth, expected return, and liquidity, when these are higher, if not greater, demand for financial assets is greater. Where the risk is greater, the demand for financial assets is lower. So this needs to be, again, another mantra that you should learn and keep in your mind when you are studying this program. That is very, very important, because this would drive your immediate response to a behavior of a financial asset. Okay, so this is another very important lesson that you are learning from today's discussion. Any questions? Right. So you see this theory of portfolio choice, and what you now discussed is presented here in a tabular form. Okay, so when you see the four determinants that we discussed: wealth, expected return, risk, and liquidity, right? So when these consideration determinants change in this variable that we are talking, when these variables increase, okay, so wealth increase, expected return increase, risk increase, liquidity increase, what happens to the quantity demanded? So when you find the wealth increases, quantity demanded also increases. When you find expected return increases, quantity demanded also increases. When you find risk increases, you find quantity demanded decreases. It decreases, okay? So then you see the liquidity. When the liquidity increases, you find the quantity demanded again increases. So this is the relationship that we discussed and now presented in a tabular form for your easy understanding. As I said, if you have any question, please feel free to communicate so we can follow up and we can discuss, right? If not, we see we can move on with the construction of demand and supply curves for the bond market. And you see supply and demand in the bond market. Okay, so what you are basically seeing is, in your general economic discussions in previous classes, previous courses, you find in y-axis, you always plot the prices. Okay, so in the x-axis, you always plot the quantity demanded. So we also go by the same concept here. But what you have to understand here is when you plot the prices, okay, what you are basically seeing is at a lower prices, the interest rates are greater. Other things being constant, ceteris paribus, what you are simply seeing is lower the price, higher the interest rates. Higher the price, lower the interest rates. Please remember that. That's the mantra that we were talking from very first day of our discussions. So at lower prices, that means higher interest rates, the quantity demanded of bond is higher. Okay, it is like expected return. So when the expected return is greater, you probably see the demand for that financial asset is greater. But from a price curve that we are now drawing, at lower prices, you find the demand for that asset is greater. That means demand is higher. So when the prices reduces, that means prices reduces means lower prices goes to further lower levels. You see, this demand would further increase. But if the prices started increasing, that means lower prices, higher demand. At higher prices, lower demand. At higher prices means what? Lower interest rates. So you just write down the same sentence that is appearing in your slide here. Instead of lower prices, you note it there in a different color, higher prices, and then go to the brackets and change higher interest rates into lower interest rates. Then you understand immediate relationship of higher prices. Higher prices mean lower interest rates. Ceteris paribus frame, the quantity demand for bond is not higher, it should be lower. That is the negative, if not inverse relationship. So the demand side of the asset bond that we are looking at here, at lower prices, higher interest rates, okay, demand for bond is greater. You have a high demand for bond. At higher prices, that means lower interest rates, the demand for bond is smaller or lower. So that's the negative relationship. So if you see this relationship, you can draw the so-called, okay, downward sloping curve for bond demand. So we'll come to that downward sloping demand curve in the next slide. But for the time being, you now know at lower prices, demand for bond is greater. Okay, so I'm talking from prices here because the price and interest rates you can interpret and nicely kind of, you know, how the relationship. But for the easiness, I'll take out the interest rates explanation. I'm just looking at prices now. But remember, prices and interest rates are inversely related. Higher the prices mean lower the interest rates. Lower the prices means higher the interest rates. So whenever I say lower the prices, it means the higher the interest rates. So lower the prices, you see, demand for bonds are greater. And then at lower prices, okay, that means higher interest rate, other things being constant, ceteris paribus, the quantity supplied for bond is lower. So demanders would like to have a higher interest rates, but suppliers at higher interest rates, they don't want to supply because their borrowing cost is high. So at lower prices, what you are simply seeing is suppliers supply low, very little bonds. Whereas at lower prices, demanders demand a big amount of bonds because they have higher interest rates. So at higher interest rates, demanders demand more, suppliers supply less. Higher interest rate means lower prices. So when the prices are higher, that means interest rates are lower, suppliers would supply more simply because the cost of borrowing is low. But unfortunately, because interest rate is low, that means higher the prices, other things being constant, then the demanders demand low. Don't confuse, right? It is very straightforward. The demand side is at low prices, higher demand for bonds. At higher prices, low demand for bonds. But in the supplier side, at lower prices, right? Suppliers supply low amount of bonds, but at higher prices, they supply a big amount of bonds. So what you are simply seeing is in the demand side, you have a negative relationship when it comes to price and the bond demand, whereas in the case of supply side, you find a positive relationship in terms of, right, bond supply. This is no different to the mango that you buy in the market, orange that you buy in the market, banana, pineapple, okay, your dress, your shoe, your storybooks, the movie ticket, all are same. So if the prices are low, we demand more. Whereas if the prices are low, the suppliers supply a little. Okay, so when the banana prices are low, more people will buy banana. Whereas the banana suppliers would supply less. When the banana prices are high, less people will buy banana. But suppliers would supply more because their profit is high. So same for mango, same for movie ticket, same for clothing, right? This is how the bond and supply and demand for bond also behave. So it's no different. It's the same economics that you have learned so far, be now brought into apply in the bond market. Please repeat what I said. The lower prices, you cut the lower and write the higher, and then change within brackets higher interest rates applicably, and then see what happens to demand for bonds, whether it is higher or lower. You can do that. Similarly, in the supply side equation, supply side explanation also, please do the same. That would make your understanding greater. So if you get this into your head straight away, it is very simple and very straightforward, and we can move on in the discussion. Any questions on that? I think there are a few questions in the form of asking to have the slides being uploaded. I've been informed it's already uploaded and it's available for all the participants who are registered with the program. So what I'm just following is again the same slides that's been shared with you all. So I'm basically taking that and discussing, right? So the other question that I'm seeing that another question being posed, whether this is quantity theory of money. Quantity theory of money is different. This is the theory of asset demand, right? So if not, theory of portfolio choice. So that's what we are discussing here. So what we are simply seeing is 4 determinants: wealth, expected return, risk, and liquidity. So what you have simply seen there is also the direction in which these related to the demand. So except risk, all the others, other determinants, the wealth, expected return, and also liquidity, positively related to the asset demand, whereas risk is negatively related. So this is portfolio theory. If not, you can say theory of asset demand. So this is what we were discussing in the the process in figuring out the demand curve and the supply curve for the bonds, okay, or for that matter financial assets. So you are seeing here the demand curve. As I said, the y-axis you have the price, whereas the x-axis you have the quantity of bonds. So when you look at these prices, you can see prices of bonds varies in this slide from 1,000 to 750, because in US the face value of a bond is $1,000, whereas in Sri Lanka it is 100 rupees. Okay, so in the case of bonds it is 1,000, that is the face value of a bond. When the face value is 1,000, you find interest rate is 0. But you find when the prices declines to 950, lower the price, higher the interest rates. So you find from 1,000 to 950, interest rate increases to 5.3. Whereas when the prices further reduces, 900, lower the price, you find higher the interest rates, 11.1. So as it's further down, you probably find up to 750 level, the interest rate is 33. So what you are basically seeing is the y-axis where the prices are presented from the point where it crosses the x-axis, that's the 0 point. So you have a break there in the curve to reduce the kind of distance that you want to draw these lines. So you find prices from 750, it increases up to the face value of a bond in US, that is 1,000. So with that, the interest rates also changes. In fact, interest rate reduces, because from 750, when the prices increase, higher the price, lower the interest rates. So you see the relationship between price and the interest rates, that is inverse. At the same time, price and the quantity demanded of bond, that is the bond curve BD. Okay, so BD curve that you are seeing in the graph also downward sloping, simply because you see at higher prices, for instance at point A, that is where the price is 950, the quantity demanded of bond is only 100, whereas prices reduces to, let's say, 750, that means lower the prices, higher the demand for bonds. You can see at point E, okay, the quantity demanded of bond is 500. So in between, you see as prices reduces from 950 to 900, 900 to 850, 850 to 800. So these are the points where you see B, C, and D, quantity demanded also increases. Lower the prices, higher the demand. Okay, so quantity demanded also increases to 200, 300, and 400. And then you see the entire curve, you join the dots here and draw the line. So that's the demand curve. So the demand curve that you are seeing here is the BD, bond demand curve. It is downward sloping, simply because higher the prices, lower the demand, lower the prices, higher the demand. Okay, so you can now draw the bond demand curve. Take piece of paper and draw this, because this is a very, very important, although it is very simple, right? So you will understand the relationship straightforward when you start kind of, drawing this type of curves. So if you do that, you can see the relationship, it is downward sloping, and that sets the bond demand curve. And similarly, you look at the supply side, that is the BS, that's the bond supply curve. You can figure it out here. At price 750, what do you mean by 750 in this particular chart? It's a lower price. So at lower prices, suppliers are discouraged. Suppliers think the interest rates are high. Their cost of borrowing, cost of financing, it's very high. So I should not supply, because only very few suppliers supply because they want somehow to raise this money. So only 100, you see quantity demanded at price 750, that is interest rates 33. So then you see gradually prices increase from 750 to 800, 800 to 850, 850 to 900, 900 to 950, and 2000. So similarly, you can see now the suppliers see when the prices increases, their cost of borrowing or cost of financing also reduces. As the prices increase, interest rates decrease. Okay. So when the prices increase, when the interest rates decrease, suppliers are now motivated to supply more. So they are supplying from 100 to 200, 200 to 300, 300 to 400, and go on. You see the prices also increasing, quantity of supply of bonds also increasing. So similarly, you can see now at price 950, the quantity of supply of bonds is 500. And if you connect these dots again, you can draw a line, and that line is the supply curve for bonds. So you are basically seeing here is now you have a bond demand curve which is downward sloping. What it explains is at higher prices, lower bond demand, at lower prices, higher bond demand, whereas an upward sloping bond supply curve where at lower prices, lower bond demand, and at higher prices, at lower prices, lower bond supply, at lower prices, lower bond supply, and at higher prices, higher bond supply. So it is upward sloping. It's a positive relationship and an upward sloping bond supply curve. So both these curves interact each other at point C. That's where the so-called concept of equilibrium. Equilibrium is the market clearing supply and demand point. Okay, so in this exercise, what you are simply seeing is at price 850, where the interest rate is 17.6, the quantity demanded is 300. That's where both suppliers and demanders are meets. So at any point above C, what you are simply seeing is quantity supply is greater than quantity demanded. That means excess supply. Suppliers are happy to supply, but demanders are not happy to demand, because at higher prices, lower interest rates, that did not motivate demanders to demand, whereas suppliers are happy to supply. But because there are less demanders, then suppliers have to come down in the sense they have to reduce the prices to motivate demanders to come, right? So that's why you see the red arrow shaping its head downward, where the excess supply points are visible. So market adjusts in such circumstances to increase the interest rates, that is to decrease the prices towards the equilibrium. And then you see in the case of the points below C, where the demanders are greater, whereas suppliers are lower. It is nothing but the concept of excess demand. Okay, so when the excess demand prevails, the demanders are happy to buy in such circumstances, but there is less supply. So to see that demanders then scale back their demand, reducing the demand to the equilibrium point to get suppliers motivated to supply. So that's where the excess demand also get clear. So these concepts that you are now familiar with, equilibrium, excess supply, excess demand, is nothing different to your basic economic understanding of excess demand, excess supply, and equilibrium. But only difference in terms of our explanation and application is this is for bond market, this is the financial assets market, market clearing bond prices, market clearing bond supply prices. And then what you are simply seeing here is the relationship of application in the form of prices to interest rates. So when you see the bond markets are always and everywhere right, being discussed and quoted in terms of interest rates, it correspondingly relates to the prices. So higher the interest rates mean lower the prices, lower the interest rates mean higher the prices. Please remember, I am telling this from the very first lecture. This is very important because that's how the financial assets work, right? So the market clearing bond demand, market clearing bond supply happens at the equilibrium. So you are very familiar with this concept now. Please draw this curve on your own. Try to link these points in your exercise and try to figure it out where the equilibrium is. So based on this, you can now very clearly explain what happens to the supply, what happens to the demand when prices increase, what happens to the demand, what happens to the supply when prices decrease. That means prices move below or higher the equilibrium. Other things being constant. Please remember that when the other things change, the behavior also changes, right? So when you see such a point, you can figure it out where the market clearing points are. Okay, any questions? Right. So then you see here, we are moving to the so-called market equilibrium. Now we explain. Okay, so the market equilibrium occurs when the amount that people are willing to buy, that is demand, equals the amount that people are willing to sell, supply, at a given price. That you know in this exercise, you can just bracket this area and just write equal C, the point C. Okay, so then you see bond demand equals bond supply again defines the equilibrium. Okay, where the price is 850 in this exercise and the interest rate is 17.6 if I'm not mistaken, right? So you see that's the market clearing price and the interest rates. But you draw the curve for price, but you know the relationship between price and the interest. Points below the equilibrium, that is where the bond demand is greater than the bond supply. Okay, so rates will fall. As the prices increases, interest rates decreases. And then you see points where bond demand is less than the bond supply. That's where the excess supply is there. So in such circumstances, prices will fall and the interest rates will rise to motivate demanders. At higher prices, suppliers are motivated because the interest rate is low, their cost of financing is low. But then demanders are not motivated to buy because interest rate is low. You have to give them a higher interest rate to get them to buy this bond. So that's what happened at points of excess supply. So those are the points above the equilibrium price in the graph. So you see this relationship, and this relationship is very much the same as what you have learned in your general economics, right? So then now we look at changes in equilibrium interest rate. So you have learned determinants of asset demand. So we'll try to kind of apply them. Okay. So what you are now looking at is shifts in demand for bonds. So demand curve is what? Downward sloping curve. Okay. So you see now shifts in the demand curve. So you know what wealth does to asset demand. So when the wealth increases, your asset demand increases. So what you are simply seeing is in an expansion of wealth, the demand curve for bonds shift to the right. So you can see when the wealth of the financial market participants increase for some reason, right? So naturally you find they become more demanders in the form of new financial assets, because they are now wealthier. They have more resources, right? So they will demand more bonds than what they used to. So what it naturally does is the demand curve would shift to the right. So the demand curve, downward sloping demand curve that you have now seen would have another demand curve that is to the right of that original demand curve. So when the wealth is increasing, you find new demanders coming into the market, and as a result, the demand curve shifts to the right. So when you see expected return, right? So when you see expected return, as I already explained, when the expected return increases, right, you start demanding more of that financial assets in comparison to other financial assets. But there's a slight difference here when we are applying this into the equation. When your expected return increases, right, what happened there is the longer term bond demand, okay, reduces. Please take that. A very important lesson here is when your future interest rates increases, right, what happened there is the demand for longer term bonds reduces. When the future interest rate increases, what happened is today's longer term bonds that you are seeing in the market looks not attractive, simply because in the future the longer term bonds that would come to the market would be at higher interest rates than the longer term bonds that is now available in the market. So as a result, the demand for longer term bonds would reduce. Even the people who demand for longer term bonds, what they do now is shift to the shorter term bonds, simply because they don't want to lock in the sense now itself demand and invest in long term bonds, but they lock their funds from longer term bonds to shorter term bonds and expect to come to the market when the new longer term bond interest rates been settled, and buy those bonds at those rates. Those rates are higher than what they are now seeing in terms of expected returns. So what this drives is when the expected returns are higher, demand for longer term bond reduces. As a result, the demand for long-term bonds curve that we are seeing in the graph that we have already seen in the slide, that shifts to the left, not to the right. Okay, so there's a little difference in terms of general understanding of expected return and its application by bringing in the concept so-called the time to maturity. So what you are basically seeing here is when the expected returns are greater, demand for that financial assets is greater. There is no argument. The theory of asset demand is very clear. The relationship is positive. But when it comes to application, right, when the expected returns are greater, you find demand for long-term bond reduces, right? So demand for long-term bond reduces. The rationale is that you don't want to invest in long-term bonds now, which are yielding low returns. But when the returns increases, will come and invest in long-term bonds. So the people who are willing to invest now in long-term change their investor behavior to prefer short-term bonds in that interim period. And then they will buy long-term bonds once the interest rates increased. So expected return is driving the long-term bond demand curve to shift to the left in the example that we are discussing. I hope this is clear. Please don't confuse this. I have seen this being repeatedly confused by many in application. Okay. So then there's another factor brought into the equation when it comes to expected return. There's another element placed behind the equation of return in terms of the concept of inflation. Okay, so inflation also very important element, because inflation would decide what's the nominal interest rates that you would be interested in. So we will be learning the concept of Fisher equation. Fisher equation would discuss about nominal interest rates versus real interest rates. So they are the one determining element of nominal interest rates and real interest rate is the expected inflation. So until you learn the Fisher equation, please keep, there's a concept called Fisher equation. I hope some of you have already learned this Fisher equation that discusses about real interest rates and nominal interest rates. But for the time being, just keep, there's a concept called Fisher equation. We will come to that. But the concept of expected inflation is important in determining the concept of expected return. So in the case of expected inflation, if you see the future inflation is increasing, okay, so naturally when the future inflation is increasing, your expected return for bonds is decreasing. Okay, so if you are looking at, let's say, 8% return now, the inflation now is 4%. So effectively you are seeing 4% inflation and you are having 8% return. But when you see future inflation is increasing to 6%, 4% inflation is increasing to 6%. So you are basically still, if you are seeing the return as 8% for bonds, right, you are effectively reducing the net return. This is the concept called real return that you will see, real interest rates that you will see in Fisher equation. Right, so that drives the investors to reduce their demand for bonds. So expected inflation also drives the demand curve to shift to the left. So expected return, as you discussed, would drive the demand curve for longer bonds, long-term bonds, to shift to the right, not to the right, sorry, to the left. Okay, expected return that reduces the demand for longer term bonds, thereby reduce the demand curve, that is to shift the demand curve to the left. Similarly, expected inflation also shifts the demand curve to the left. And risk, the other very important element that you have seen, and any financial assets, if you find an increase in the riskiness of bonds or any other financial assets, naturally causes the demand curve to shift to the left. So you are not willing to go and invest in any assets where you are not sure that asset will honor its obligation. So if you find the uncertainty of your returns, timely honoring your receipts in the form of bonds, the coupon payments, in the case of bonds, it's coupon payments, and also the maturity payments on time, you find if the uncertainty of such payment structures are increasing, so what you do is you basically move out from such investment. So what you are basically seeing is higher the risk, okay, you find the demand curve for the bond would shift to the left. And liquidity, the speed and ease in which you can convert your financial assets into cash mode, if the liquidity is greater, right, increased liquidity of bonds results the demand curve shifting to the right. So you demand more of that assets. You don't need to worry. You can just convert this into the cash form very easily in the market. So what you are basically seeing here is the liquidity for bonds result in the higher demand for bonds. Okay, so liquidity is a driver that would drive the demand curve to the right. So risk, as you studied, which is a driver that reduces the demand for bonds, so that drive the demand curve to the left. Expected inflation and expected return. Expected inflation, that means that reduces the return for bonds and drives the demand curve to the left. Expected return, that reduces the demand for long-term bonds and drives the demand curve to the left. The wealth, as you already know, would increase the demand for bonds and drive the demand curve to the right. So now you can apply these into the curves here. So shift in demand curve for bonds, you find all the points in the bond demand curve 1 is shown in terms of bond demand curve 2, where the demand curve is shifted to the right. So here the increase in demand for bond, for reasons that we have already discussed, has been shown in isolation. So supply curve is not here. If you see the supply curve, you probably see the possible impact because of this demand to the equilibrium price and the quantity. So you see here everything being pooled now. So all the drivers which shift the demand curve for bonds being pooled together in this equation. Okay, so when you see the wealth, change in variable is positive, that means wealth is increasing. You probably see the change in the demand of the bond is also, okay, is increasing. That means the demand curve is shifting to the right. So you can see here the BD1 is moved towards BD2. The demand curve shifted to the right side. And you see the expected interest rate, that is expected return. When the expected return is increasing, you see the demand for long-term bond is decreasing for each point in prices that you are driving or drawing this particular bond demand curve. So what you are basically seeing is the bond demand curve 2 from bond demand curve 1, that is in blue color, and the bond demand curve 2 is in red color. So you see the demand curve is now shifting to the left. Okay, so expected increase in return. Okay, so that drives out the demand for longer term bonds, and as a result a lower demand, and the curve is shifting to the left. And expected inflation, again, increasing expected inflation reduces the quantity demand at each point. As a result, you find here the bond demand curve shift to the left. So then you see the risk. Okay, so riskiness of a bond increases means anyway people would move away from investing in bonds. So higher the risk, lower the investments. Okay, so when you see higher the risk, lower the investments, so people move out from the investing in risk, so you investing in bonds because of the riskiness. So the bond demand curve shift to the left. And the liquidity, speed and ease in which you can convert these financial assets into cash form, that sets the demand to increase. More people would demand that financial assets because that can be easily converted to cash. So then you find the demand curve shift to the right. So at points where wealth is increasing, liquidity is increasing, you find the demand curve is shifting to the right. And the expected rate, interest rates, expected inflation and riskiness would drive out the investors demanding bonds, and as a result, what you simply see is the demand curve shifting to the left. So this is very, very straightforward when you basically keep other things not disturbing this relationship. That is the so-called ceteris paribus condition. So that's been applied. You find the relationship between demand curves in the form of moving to which direction in the financial market. So this is a very good and a very easy understanding for anybody who wants to kind of get into bond demand market, bond demand curves, and see where the direction of these interest rates and driving, after all, the demand for bonds. Any questions before I move on with the a further explanation into the concepts and related areas of discussion? Right. So we'll move on to discuss the supply side of the equation. So you have now familiar with the shifts in the demand side of the equation, and you have seen how that responded to the direction and which direction the demand curves moved. And now we look at the supply side, and you basically know price and the quantity supplied of bonds are positively related. At lower prices, quantity supplied by bond suppliers are lower. At higher prices, quantity supplied by bond suppliers are higher. Simply because at lower prices, interest rates are greater, if not higher, right? Interest rates are higher, mean cost of financing or cost of borrowing by bond suppliers are higher. So they prefer to supply lower amounts of bonds. But when prices increases, interest rates decreases. So when interest rate decreases, the cost of financing of bond suppliers are decreasing. So they are motivated to supply more bonds. So at higher prices, they prefer to supply more bonds, and the supply curve is upward sloping. So bond supply and bond price are positively related. That's why you see an uh, upward sloping bond supply curve in the equation. So now you are seeing here is shifts in the supply curve that we discussed. So when you see supply side, there are elements. One is the expected profitability of investment. Okay, so expected profitability invariably signals that new investment opportunities for the business or the enterprise. So they want more funds being invested. So in such a situation, it's natural that you expect more bond supply to come into the market. So when you see the business cycles expansion periods, where the GDPs are growing, everybody is expanding their businesses, new investments being brought into the economy. So it's very, very natural to expect that you find more supply of bonds. So when you see more supply of bonds because of the higher expectation in terms of new opportunities and profits, so what you are basically seeing is new supplies at the same prices. So the bond supply curve shifts to the right. So more bond supply to the market. So as a result, supply curve shift to the right. So expected inflation. Okay. So an increase in expected inflation, right? So when you see inflation is increasing in the future, bond suppliers know future borrowing cost has to be higher. They also need to increase interest rates. That means people would expect more in terms of return when the inflation is increasing. So for that, if they expect inflation to be, expected inflation means inflation in the future. So when the inflation in the future is higher, you find today the bond suppliers try to supply more bonds, because today the inflation is not that higher like what you expect in the future. So you better, okay, borrow these funds now rather than waiting next year, because inflation is expected to increase, and then your cost of financing would be higher. So today what you are seeing here is, when the expected inflation is there, as a supplier you supply more if you expect future inflations to be higher. So more supply of bonds means bond supply curve shifts to the right. Okay. So the other element is, let's say, government side. When the government's budget is in deficit, okay, increased budget deficits requires governments to finance its deficits on a continuous basis. How they finance these deficits is by issuing more bonds. So issuing more bonds means the supplying more bonds. So when the budget deficits are higher, it's no different to say when the deficits of enterprises also higher, or revenue of enterprises is lower for that matter, right? That shifts new bonds to the market, that supplies new bonds to the market, and as a result, the bond supply curve shift to the right. So what you are basically seeing here is expected profitability, expected investment opportunities, expected inflation, right? The budget deficits or reduction in revenue all would drive more bonds to be supplied, and as a result, bond curve shift to the right. So you are seeing this in this presentation now. So the profitability of investments, which is increasing, the change in variable is increasing. So what you are simply seeing is the quantity supplied at each bond price also increasing. And as a result, the bond curve, supply curve, shifts to the right. So you see bond BS2, red color, is now in the right side to the BS1, the blue color curve in the chart that you are seeing. Similarly, expected inflation, when the expected inflation increases, you find future cost of borrowing is higher. So you better take actions to increase your bond supply today and benefit from prevailing interest rates. So then you do a new bond supplies, and you find bond supply curve shift to the right. And similarly, government deficits need to be financed by supplying more bonds. So the government also would supply more bonds to the market, and as a result, bond supply curve shift to the right. So these are the elements that you see in the supply side of the equation, which drives the supply curves to behave either to the right or to the right, to the left. So when you see all this profitability, expected inflation, the deficits of the government which are increasing, means you find the more bonds needs to be supplied, and that results in bond supply curve shifting to the right side from what you have seen under normal circumstances. So it's very clear for you now what drives bond supply, what drives bonds demand. And bond demand was very clear in explaining. You also factored in expected inflation, expected return, that generally kind of explain in a sense of general direction to increase the bond demand, but effectively in the interim that drives the bond demand curve to shift to the left. Bond demand curve to shift to the left. Please remember that. So that's a kind of a difference from general direction of a theory of asset demand that we discussed. So this is very broadly the direction that we discussed, and here you see the supply curve behavior shifting to the right from blue curve BS1 to BS2, an increase in the supply of bonds shift the bond supply curve to the rightward. So as a result, what you are simply seeing is a new supply curve for each prices that you have seen in the graph at the new quantity of bond supplied as per the direction. So this is also in isolation that you present the supply side here. So we will be able to kind of join these things into a demand and supply position. Okay, so where the supply is in blue, original positions are in blue, both supply and demand, that is point 1, where the equilibrium price is P1. Okay, so what you are basically now seeing is a rise in expected inflation. Okay, when the expected inflation increases, you already know the bond demanders reduce the bond demand, and as a result, bond demand curve shifts to the left. Okay, so when the expected inflation drives the demanders to reduce the demand, as we studied or discussed in our demand side behavior of demand curve, so the demand curve shifts to the left side here. So they have reduced the demand. So the demand curve BD2 that you see from BD1 is now into the left side, right? Then you see suppliers' behavior. They know expected inflation. That means future cost of borrowing is increasing. So they don't want to wait till future because cost of borrowing is higher. So they shift the bond supply curve now to the right side. They increase the bond supply, right? So when the demand is reducing, supply is increasing, right? So to attract investors to buy more bonds, you have to reduce the prices. That means increase the interest rates. So what you are simply seeing is the price has reduced from P1 to P2. And the new equilibrium point is point 2 in the equation, where the price of bonds has fallen and the equilibrium interest rate, in fact, lower the price. Price fallen means equilibrium interest rates have increased. So price reduction invariably results in interest rates to increase. That's very common. When the interest rates increase, you probably see the demanders' behavior would change, right? So you basically factored now both elements of supply change and demand change and the behavior in the form of expected inflation, and that shifted the demand curve to the left, whereas the supply curve, okay, shifted to the right, and as a result, the equilibrium price has now settled at P2, lower price than originally you have seen in P1. And as a result, the interest rates, lower the price means interest rates are greater. So this is a good ideal point for us to stop today's discussion and start from the elements. That's how empirically these things have driven expected inflation and expected interest rates have driven the markets in the past, and how the behavior in US financial markets, and also then we can kind of see some other elements which are driving the interest rates behavior, and we will continue the interest rates discussion, interest rates behavior discussion next week also. Possibly we'll be able to start a new area that also related to interest rates with interest rates concepts in our discussion. Any questions before I conclude the discussion for today? Please keep the documents or the presentations with you and read through. That would further help you to kind of understand these concepts much more clearly. and you'll be able to then apply some of these stuff in your leisure time in terms of drawing some of these basic curves and also rewording the basic concepts when I have presented it only in one side, like higher. So you try to kind of reduce to bring in lower and rewrite it whether you understand the concepts right. So that would give you a basic framework to kind of think fresh when we meet next week. So if you don't have any questions, you can conclude the discussion today. So we'll meet up next week. Stay safe. Thank you.